Hi everyone, welcome back to my channel. I hope tax season is going well. It has been pretty busy at the tax clinic, but I'm happy I can help make a difference in my community. In part 2, I will provide a high-level overview of how self-employment income and expenses are reported using the accrual method and the cash method. There are two ways to report self-employment income: the cash method and the accrual method. The key difference between the cash method and the accrual method is the timing of when income and expenses are reported. The CRA has specific requirements. For instance, farmers, fishers, and self-employed commission agents can use the cash method or the accrual method to report income. All other self-employment income must be reported using the accrual method. When you use the cash method, you must report income in the period received it and deduct expenses in the period paid. This method is simple and flexible, and it provides some tax planning opportunity to control the timing of income and deductions. However, this approach doesn't provide a complete picture of a business' financial performance. There are special rules for prepaid expenses. You cannot deduct the portion of the prepaid amount in the current year if the related benefits will be obtained 2 or more years after the expense is paid. This portion can be deducted in a future tax year when the benefits are obtained. The CRA has other special rules, such as rules for post-dated checks and inventory. Please refer to the CRA website for details. When you use the accrual method, you must report income in the period earned and deduct expenses in the period incurred. It doesn't matter when you receive the money from your customers or when you make payments to your suppliers. This approach matches the timing of income and expenses, and it provides a more accurate picture of financial performance. For prepaid expenses, you can only claim the deduction in the year or years in which you get the related benefits. Some people incorrectly assume that they could deduct everything for their business, which is not true. The Income Tax Act specifically indicates that expense is deductible only if it was made for the purpose of gaining or producing income from the business or property. Also, expenses must be reasonable. This means that a reasonable person would pay the same amount to a third party for the same services. For example, if you wanted to hire your family member to work at your business, you should ensure the salary or wages you pay are reasonable. In addition, capital expenditure cannot be deducted. Instead, you can claim the capital cost allowance (CCA). Generally, this is calculated using a CCA rate. You do not have to claim the maximum amount of CCA. You can claim any amount you like, from zero to the maximum allowed for the year. If your taxable income is very low for a particular tax year, or if you don't have to pay income tax for that year, you may choose not to claim CCA. In order to support your income and expenses, you must keep records of all of your transactions. You don't have to attach your business records with your income tax return. However, you must keep your business records in case the CRA wants to see supporting documents. If you do not keep your records and cannot support your deductions, the CRA may disallow your deductions. Also, there are penalties for not keeping adequate records. Okay, that's it for part 2. Thank you so much for watching. See you next time. Good luck with tax season.